It is 1931. The entire world is drowning in the darkest financial depression in modern human history. Banks are shuttering their doors forever. Unemployment is soaring past 25%. And millions of terrified citizens are standing in endless lines just to get a single loaf of bread. To anyone watching, the future looks completely hopeless, but inside a quiet, dimly lit office in New York, a 20-something investor named Benjamin is doing something that seems like absolute madness. While everyone else is desperately selling off their assets for pennies, Benjamin is carefully going through dusty corporate records, discovering businesses whose cash in the bank is literally worth more than the total price of their stock. He realizes a shocking, hidden truth that no one else can see. The market has become so consumed by sheer terror that it is giving away real, profitable businesses for less than free. Fast forward several decades. As the dust of the Great Depression settles, that exact same young man emerges not just wealthy, but as the legendary pioneer of value investing who would later mentor Warren Buffett himself. But wait. How did a young, unknown investor spot life-changing opportunities in the middle of the worst economic nightmare the world had ever seen? While millions of seasoned professionals lost everything, was it sheer luck? Or did he crack an invisible economic code that repeats itself during every single crash, including the ones we face today? If you think the financial game is rigged against young people during a recession, pay very close attention to what happens next. Because the hidden pattern behind historical market panics is about to shatter everything you thought you knew about money. Let us journey back to another critical moment in history. Autumn of 1974, the economy is staggering under a brutal stagflation crisis. Oil prices have skyrocketed by 400%, and the stock market has just suffered its worst drop in 40 years. Panic is everywhere. News anchors are openly declaring that the era of American prosperity is over. In the middle of this chaos, a 34-year-old manager sits at his kitchen table, analyzing a regional newspaper business called the Washington Post. The entire market is treating the newspaper company like toxic waste. Its stock price has plunged by over 50% in a matter of months. Yet, as this young manager digs deeper into the actual numbers, he notices a mind-blowing contradiction. The company has zero risk of bankruptcy, its subscriber base is loyal and growing, and its underlying revenue is steadily rising. The market cap of the entire business has dropped to just $80 million, even though the physical printing presses, real estate, and brand equity are conservatively worth over $400 million. Think about that for a second. The market is offering a world-class monopoly business at an 80% discount, simply because the public is terrified of the word recession. The manager takes every dollar of available capital and buys a massive stake in the company. Over the following decades, that single decision turns an initial investment into hundreds of millions of dollars, locking in a staggering return of over 10,000%. But here is the massive cliffhanger that keeps smart 25-year-olds awake at night. How do you actually train your brain to spot these massive valuation disconnects before the rest of the world catches on? To uncover this secret, we have to break down the actual mechanics of how assets get mispriced during a historical crisis. You see, during normal economic times, market prices are roughly driven by performance and earnings. But when a recession hits, logic completely vanishes from the room. Wall Street firms and institutional funds face sudden, massive margin calls and investor withdrawals. They are forced to sell whatever they own, good or bad, simply to raise immediate cash. This creates what historians call a forced liquidation cascade. Imagine a high-end estate auction where the seller is forced by a judge to sell everything by midnight, no matter how low the bids are. A pristine, priceless painting that would normally sell for $1 million is suddenly on the auction block. And because nobody in the room has cash, it gets sold for $10,000. The painting did not lose its beauty or value. The seller simply ran out of time. This exact same phenomenon happens in the stock market during every single downturn, giving young investors with patient cash an unfair generational advantage. Let us look at a fascinating micro-case study from the 2008 financial crisis to see how this plays out in real life. Consider a quiet, unassuming 25-year-old named Alex. While his peers were glued to the cable news channels watching financial institutions collapse, Alex spent his evenings analyzing a fast-growing digital payment company. The news was screaming that consumer spending was dying and that financial tech was finished. The company's stock was dragged down by 70% along with the broader market panic. But Alex looked past the price chart and examined the company's internal metrics. What he found was astonishing. Even in the depth of the recession, people were still using this digital platform to pay for everyday goods. Transactions were actually increasing month over month. The company had zero debt, millions in cash, and a business model built for the future. Alex realized he was staring at a once-in-a-decade anomaly. The business was fundamentally stronger than ever, yet its ownership was being sold at a throwaway price. He didn't try to guess the exact bottom of the crash. Instead, he set up a strict system, investing a fixed portion of his modest monthly paycheck into the stock every single week. As the panic raged on, he bought more and more shares at lower and lower prices. Fast forward 7 years. As the economic cycle turned and digital payments became the global standard, those exact shares grew by over 1,200%, converting a tiny, consistent investment into a life-changing foundation of wealth. So, what is the hidden corporate strategy that makes certain businesses thrive during a recession while others collapse? It comes down to a concept called the economic moat. During periods of prosperity, almost any company can look successful. Cheap credit masks bad management, and rising tide lifts even the weakest boats. But when a recession drains liquidity out of the system, the tide goes out. And you finally see who has been swimming naked. Smart 25-year-olds do not look for flashy, trending companies during a downturn. They hunt exclusively for businesses with wide economic moats. These are companies that possess unbeatable structural advantages, like proprietary technology, massive cost efficiencies, or high switching costs that lock in customers when an economic storm hits. These moat-protected companies don't just survive, they actively consume their weaker competitors. They buy up distressed assets for pennies, hire top-tier talent for lower salaries, and expand their footprint while everyone else is shrinking. By the time the recession ends, their competitive advantage has multiplied 10 times over. Now, let us address the psychological demon that stops 99% of people from taking action when these opportunities appear. It is called the paradox of certainty. When market prices are high and everything feels safe, people feel confident buying, but when market prices are crushed and assets are on sale, people demand complete certainty that the economy has healed before they invest. Here is the brutal financial truth you must memorize. Certainty and bargain prices cannot exist at the same time. By the time the news announces that the recession is officially over, by the time unemployment drops and confidence returns, asset prices have already skyrocketed back to fair value. The life-changing gains are made in the dark. In the middle of uncertainty, when buying requires real courage, discipline, and a firm belief in the long-term economic cycle, think about the incredible biological advantage you hold at 25 years old. Older investors who are near retirement cannot afford to ride out a multi-year economic cycle. If the market drops 40%, they panic because they need that money to pay for their immediate living expenses. They are forced to sell at the worst possible time, but you, at 25, have the ultimate financial luxury, time. A 3-year recession is nothing more than a brief blip on a 40-year compounding horizon. You don't need to panic. You don't need to sell, you simply sit back and let time multiply your ownership. Picture 2 young professionals standing at a crossroad during a major market downturn. The first professional listens to the doom and gloom media, gets terrified, and moves all their savings into a low-yield cash account. They tell themselves they are playing it safe, but in reality, inflation slowly eats away their buying power while they miss the single greatest wealth-building window of their decade. 10 years later, they are still working long hours, wondering why their hard work never translates into real financial security. Now look at the second professional. They study the lessons of financial history. They understand that market crashes are temporary, but ownership in great businesses is permanent. They trim their personal expenses, Stay focused on building skills and systematically buy high-quality, discounted assets every month while panic dominates the headlines. A decade later, as the global economy sets brand new historical highs, that decision has transformed their life, giving them total freedom, peace of mind, and option value over their time.